It is my understanding that the Treasury has discretion over the debt management process. Is this correct? And if so, where does this discretion derive from?
Yeah, Treasury does have relatively broad discretion within to manage federal debt. So there's a lot of places in statute where that's provided. One of the big places is 31 U.S.C. in the 3100s. And so, Congress can certainly make changes to the what sort of powers they delegate to Treasury, but there is a lot of power with the Treasury Secretary and more generally.
So rulemaking also under the Code of Federal Regulations, I see, has happened over the years as well.
Yes.
So do you know, since that time of that statute, like when is the most recent modification that to the statute was made that is impacting the ability of the Treasury, either for the better or worse, to manage our debt?
Sure. So I think the most observers would say kind of the last significant changes made to those portions of the code were several decades ago. I think there were large changes in the 1970s and 1980s, largely to make the process a little bit more predictable and transparent. There have been some small changes since then, 2010 and others, but I think significant, you're talking several decades.
Still significant ability to manage the debt.
Right.
Exactly. Thank you so much. As many know, the United States has benefited from historically favorable credit ratings, allowing the federal government to issue treasuries on relatively favorable terms. However, as funding deficits and projected debt to GDP ratios have grown over time, the country's credit rating has not. For example, on August 1st, 2023, Fitch Ratings downgraded the country's long-term foreign currency issuer default rating from AAA to AA+, which was the first time a ratings firm lowered its assessment of the U.S. government's ability to pay its debt on time since 2011. Mr. Falconer, can you please describe the relationship between Treasury's debt issuance strategy and credit ratings?
Sure. So all bond issuances have to be rated in order for many mutual funds and different fund families to hold them. And so there's the rating agencies differently model out governments, corporates, utilities, and financials, and then they set a rating on the likelihood of being repaid. Treasury meets with the three major rating agencies each year to discuss the fiscal outlook and to give, and from that information they obtain, the rating agencies then provide a rating that is as been said by my panelists, the foundational interest rates that are provided in global financial markets.
Well, let's bring this home. How does this affect American families? The bottom line there.
So the higher the borrowing costs for the U.S. government, the higher the borrowing costs for nearly every other form of credit for the American people. So it's not just that they are going to pay higher taxes in the future to support higher interest costs, but any borrowing they're doing in their own household is going to be higher if U.S. Treasury rates are higher because their bond rating is lower.
Thank you. So quickly, since I'll stick with you, Mr. Falconer. You may recall a slide that Mr. Kogan shared earlier today during his testimony, which argued that revenue and spending are both lower than earlier projections, suggesting that low revenues are responsible for the persistent primary deficits. So what are your thoughts on this, and do you agree with Mr. Kogan's proposal?
Well, again, the revenue forecasts relied upon current law extending in ways that it's not clear Congress actually would have. So we suffered, for instance, from what's known as bracket creep, which is that as people made more money, a higher portion of their income was then thrown into a higher tax bracket. In order to have those CBO projections continue, you would have had to assume that Congress would not have fixed that. Likewise, as we know, the alternative minimum tax, for instance, was implemented to capture a couple of millionaires that weren't paying very much in federal income taxes. And yet by into the 2000s, you had a few million taxpayers being hit by the AMT, and so Congress came in and modified it because it extended beyond what its original objective was. One has to presume that Congress would not have made those fixes that American households would be paying about 25% higher taxes today.
Well, let me ask you this. Aren't a lot of these things static numbers? Isn't there a lot of growth that happened because of the Tax Cuts and Jobs Act?
So that is the other piece, is that you have to presume that we would have continued to have the growth output we had. We saw higher growth rates following the Tax Cuts and Jobs Act. There's some recent academic work that shows that. It's hard to argue that we would have had the same economic output and the same spending levels had tax rates been
historically, where are we with revenues today?
Revenues is a percent of GDP, which is, I think, the best way to look at it. In 2022, for instance, we're the fourth highest on record.
Greetings, friends. This is important news. Lawmakers in select states have just announced that the application period for direct payments are going to be opening soon. All households who qualify are being urged to take action so they may receive their chunk of the relief fund. My dear friends, please make sure that you watch until the end of this video to hear about all of these details. Also, every Friday, I will be announcing several winners for the Walmart gift card giveaway. If you would like to enter these weekly giveaway, friends, please click and like several of my videos and then comment below the keyword of each video that you watch. The more videos that you comment on, friends, the greater your chances of winning these giveaways. Now, friends, according to the Washington Examiner, in 11 days, the 2024 application period for the Alaska Permanent Fund Dividend Program will be open to eligible residents. Residents will be able to apply for the program for the year from January 1st, 2024 to March 31st, 2024. The state program offers a direct payment annually based on Alaska's mineral revenues for that year. To qualify for a check, an applicant must be an Alaskan resident who intends to remain a resident of the state indefinitely, among other requirements. To receive a check from the program, a resident must apply during the application window, even if that person has received a payment in the past. Some individuals who don't file by the March 31st deadline may be eligible for an exemption past a regular application period. Residents can fill out their applications for the program either online or through a paper form. The status of a resident's application can also be viewed on the state's website. For 2023, the Permanent Fund Dividend offered checks worth $1,312 from the state of Alaska and began going out to eligible residents in October. The Alaska Department of Revenue Commissioner said in a statement about the 2023 checks, "This year, we processed over 8,000 more applications than in 2022. The 2023 Permanent Fund Dividend will inject nearly $1 billion into the state's economy and directly into the hands of Alaskans." When talking about the Federal Reserve cutting interest rates, it's not a matter of if, but rather when. Policymakers at the U.S. Central Bank have signaled that they plan to reverse some of the significant rate hikes implemented since 2022 to control inflation. This surprising revelation came after the final rate-setting meeting of the year. Out of the 19 officials on the Federal Open Market Committee, only 2 expect interest rates to remain in the current range of 5.25% to 5.5% by the end of 2024. The majority anticipates at least 1 rate cut, with one official even suggesting 6 cuts. So while the timing is uncertain, investors hope for a swift end to the highest interest rates in over 2 decades, with expectations of rate cuts starting as early as a second meeting in March. Looking at year-end projections, one official foresees only 1 rate cut for 2024, while others predict 2, 3, or even 4 cuts. The median estimate suggests a target range of 4.5% to 4.75% for the key federal funds rate, indicating 3/4 point rate cuts for the coming year. The shift in projections contrasts sharply with the Fed stance just 3 months prior, signaling a notable change in their outlook. The improved economic conditions, with higher than expected growth and lower unemployment, have prompted discussions about the possibility of rate cuts. The focus still is on inflation, with some Fed officials suggesting that if inflation continues to decelerate, rate cuts may become necessary. While the exact timing of rate cuts remains uncertain, there is a growing acknowledgement that the reasoning behind them is evolving. The consensus is that near zero interest rates are not imminent unless a major economic catastrophe does occur. The message for consumers is clear. Unless faced with a severe recession, significant rate cuts leading to near zero interest rates, are unlikely in the near future. Borrowers are also advised to focus on managing high cost, variable rate debt in this evolving economic landscape. So, dear friends, what are your thoughts on this? Do you think that our economy is improving? Please let me know what your thoughts are in the comments section below. That is the end of my daily stimulus update video for today. My dear friends, thank you so much for being part of this community. Tomorrow, which is Friday, I will be announcing several winners for the Walmart gift card giveaway. If you would like to enter the weekly giveaway, friends, please click and like several of my videos and then comment below the keyword of each video that you watch. The more videos that you comment on, friends, the greater your chances of winning these giveaways. Thank you and have a wonderful and very blessed week.